Luxembourg generally accepted accounting principles refer to the accounting standards and practices applicable to entities incorporated or registered in Luxembourg. Luxembourg generally accepted accounting principles are based on Luxembourg's legal and regulatory environment, including laws such as the Law of 19th of December 2002 and specific fund-related laws, such as the Specialized Investment Funds (SEF) law and the Reserved Alternative Investment Funds (RAIF) law. Entities following Lux generally accepted accounting principles prepare annual financial statements based on the Luxembourg legal framework. Here's how they apply to the income statement and statement of financial position. 1. Accrual basis. Luxembourg generally accepted accounting principles, like IFRS, typically follows the accrual basis of accounting, recognizing revenues and expenses when they are earned or incurred, regardless of when cash is received or paid. 2. Prudence. Luxembourg generally accepted accounting principles, similar to IFRS, emphasizes prudence or conservatism in financial reporting, encouraging caution in the recognition of revenues and assets and the disclosure of potential losses or liabilities. 3. Materiality. Luxembourg generally accepted accounting principles requires that financial statements disclose material information that could influence the economic decisions of users. Materiality thresholds may vary depending on the size and nature of the entity. 4. Consistency. Consistency in accounting policies and practices is important under Luxembourg generally accepted accounting principles, ensuring that financial statements are comparable from one period to another. 5. Going concern. Luxembourg generally accepted accounting principles, like IFRS, assumes that the entity will continue to operate for the foreseeable future unless there is evidence to the contrary. This principle guides the preparation of financial statements and the valuation of assets and liabilities. 6. Substance over form. Luxembourg generally accepted accounting principles, similar to IFRS, requires that transactions be recorded and presented based on their economic substance, rather than merely their legal form. 7. Fair presentation. Luxembourg generally accepted accounting principles aims to present financial statements fairly and accurately, providing a true and fair view of the financial position, performance, and cash flows of the entity. 8. Disclosures. Luxembourg generally accepted accounting principles may include specific requirements on disclosures driven by business specifics. Income statement. Revenue recognition principles under Luxembourg generally accepted accounting principles typically align with IFRS, recognizing revenue when it is earned and realizable, and expenses when they are incurred. Statement of financial position. Assets, liabilities, and equity are typically reported at historical cost or fair value under Luxembourg generally accepted accounting principles, depending on the specific accounting standard or regulation applicable to the entity. Classification of assets and liabilities as current or non-current is based on their expected realization or settlement within the normal operating cycle of the business. Overall, while Luxembourg generally accepted accounting principles may have some unique aspects or interpretations compared to IFRS, they generally aim to achieve the same objectives of providing relevant, reliable, and comparable financial information to users.